Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Huang. We've got a bit of red on the screen. The S&P 500 down 0.6% at 5,650. We've got the Nasdaq Composite lower by 0.7%. And the Dow Jones Industrial Average slightly underwater by 0.2% at 41,219. So lots to talk about as we digest what's going on in the tariff environment. And to help us out this morning, we've got Dave Sekera. He's the Chief U.S. Market Strategist for Morningstar Research Services. Dave, good morning. How are you doing today?
Hey, good morning, Ryan. I'm doing well. How about yourself?
Well, I'm doing good as well, and glad to have you on because we've got a lot to unpack here. Let's start with where we are right now in the tariff environment. Are things getting better or worse? Because on one hand, we hear about how Donald Trump is trying to reach a deal with his trade partners. On the other hand, we've got him saying he's looking to Hollywood films with 100% tariffs if they are not made in the U.S. What do you make of what's going on right here?
Well, to me, it feels like we're in the eye of the hurricane right now. When I look at the U.S. markets, I think we could start seeing the impending storm coming as early as March. We had the bear market in the AI stocks, but really the hurricane landfall hit when Trump announced the Liberation Day tariffs, in early April. Stocks in the U.S., of course, plunged. We fell into bear market territory. We were down, 20% from the highs. And our own valuation metric, though, was telling us that we thought the market was getting to be too undervalued. It was trading at a 17% discount to our fair value metric. So we actually moved to an overweight for U.S. equities on April 7th on our podcast, The Morning Filter. And of course, thereafter, Trump did implement his 90-day pause. The skies have started to clear. And the focus in the U.S. really has shifted to earnings season, which thus far have been pretty benign. But I feel we're just in a short-term period of relative calm. At this point, the trade agreements still need to be negotiated. This pause is until July 8th, so I suspect we won't have any new agreements completed until we get closer to that deadline. And we're going to see, I think, a whole host of supply and transportation dislocations in the U.S., from these disruptions. Probably will lead to some earnings distortions. And we do know the U.S. economy right now is, slowing.
Yeah, so a few weeks away from that deadline. So investors will be looking at, I suppose, data in the next few weeks. How close should we be paying attention to these data points?
Well, as far as the economy goes, I'm actually not paying much attention to them at all. There was a famous investor, Peter Lynch, who had a comment once where I think he said something to the effect of, if you spend 13 minutes a year, on the economy, you spent 10 minutes too much. And I think we're in kind of that environment right now. So we had, GDP, the gross domestic product report that came out recently in the U.S. It showed a negative print for the first quarter. But, a number of weeks ago, I was telling investors here to ignore that number. Essentially what was going to happen and what we saw happen is that, there were a lot of purchases, a lot of imports made as people were trying to get, the materials that they needed in before the tariffs were going to run. And of course, that artificially lowered first quarter GDP. Now here in the second quarter, once that inventory starts getting used up, that's going to then artificially bolster the second quarter GDP. In fact, our U.S. economics team is forecasting GDP in the U.S. to be about 2%. So in my mind, I don't think either first quarter or second quarter headline GDP is reflective of the real economy in the U.S. So our base case is that real GDP is still positive, yet we expect real GDP, the underlying fundamentals, will decline sequentially throughout the rest of 2025.
All right, lots to watch out for. I think the earnings season, that's underway, so we are also trying to figure out where things are going with the commentary and an outlook of the coming quarters. And just coming through with the tech earnings in recent days, we've got the likes of Microsoft, Meta, and other tech companies reporting numbers. And what stands out for me is how on some fronts it seems quite resilient, especially the ad spending. So digital advertising seems to be quite strong, which suggests that advertisers are still quite optimistic. What do you take away from the optimism, or at least the numbers here?
Well, to some degree, I think the optimism that you're seeing there is also because the digital advertising is still taking share away from the traditional advertisers. And companies like Meta, we think, are actually taking share from some of their online competitors. So we're seeing ad dollars flow away from lower return on ad spend vendors like Snap. So that's one of the reasons that we actually have a very positive outlook on Meta. In fact, that's a 4-star rated stock, trades at a 22% discount. They have pretty strong financial results, seeing good operating margin expansion. And I think this is one of the stocks that's going to be a play on one of the themes we see here in 2025. And that's our expectation that the markets will continue to keep rotating out of, the AI hardware stocks, the NVIDIAs of the world. Those are the stocks that worked the past couple of years. But we're really looking for those stocks where the companies are able to utilize AI in order to drive top-line growth, drive more margin over the course of this year and next, really as being the next beneficiaries of the AI trade.
All right, your other winner that you're picking is Microsoft from the latest earnings season. They've also got some AI moves as well. So what sort of upside are you looking here?
It's a 4-star rated stock, trades at a 14% discount, had a very strong upward momentum after they reported earnings. When I look through their earnings, it's pretty much everything that you want to see in a quarterly report. They're just still hitting across all business lines, hitting on all cylinders. Their guidance for this next quarter exceeded all expectations. But as you talked about their AI business, that's Azure, which hosts artificial intelligence, which even though it's capacity constrained, still grew 35%. So that's still really the star performer in that company. So we actually increased our fair value on that stock up to $505 a share.
All right, talking about AI, Apple's been trying to jump on the bandwagon of Apple Intelligence by introducing it to its devices. So where does Apple sit in this equation? At the same time, it's facing some issues with tariffs. So what sort of prospects does it have here?
Well, right now, Apple stock is down about 18% year to date. It still trades at a 7% premium above our fair value. So not a stock that I'm looking at, being very attractive at the current valuations. The margin guidance was a bit weaker than what we expected. That did include, higher costs from tariffs on accessories. The phones are still exempt for now. Our base case is that the phones will stay exempt. However, there is significant downside risk in our view if those tariffs are applied on Apple cell phones here in the U.S. The iPhone does account for about half of the company's revenue. And of course, most of those phones right now are produced in China. So this is one where I still think you're probably better off steering clear for the company for now, looking for those other stocks that we find trading at significant margins of safety from our long-term intrinsic valuation.
All right, talking about what to buy, what is on your shopping list right now, especially if you look at the common adage, sell in May and go away. Should you be looking at markets for bargains right now, or should you be just staying on sidelines?
Like anything else, it's all about positioning at this point. So the market in the U.S. overall is trading at an 8% discount. So it's looking attractive, although not necessarily cheap, at this point in time. We still like value stocks over growth stocks, but specifically for what I consider to be a potentially turbulent spring and summer, looking for those companies that have long-term durable competitive advantages, trade at a significant margin of safety below our valuation. I like stocks that pay very attractive dividend yields, looking for those that have a low to medium uncertainty, and of course those in defensive sectors that I think will benefit from the rotation out of the more economically cyclical sectors that I expect to see in the second half of this year as the U.S. economy continues to slow.
Yeah, so with that in mind, where do banks sit in that equation? Because we are also looking out for potential rate cuts.
So most of the mega U.S. banks are already fully valued to overvalued. Some of the better opportunities in the U.S. are among the regional banks. So one we've been highlighting right now is going to be U.S. Bank. That's the largest of the regional banks. It's the only one that we assign a wide economic moat, meaning that we see long-term durable competitive advantages in their business. And of course, being a U.S. regional bank, not necessarily subject to the Trump tariff volatility. That's a 4-star rated stock, trades at a 24% discount to our fair value, and provides investors with a 5% dividend yield.
All right, in the space of consumption, where are you looking at for opportunities right now? Because they are, in some sense, facing a lot of headwinds when it comes to production, in terms of where they produce, in terms of the tariffs that might be slapped on them, as well as the wider backdrop of consumers tightening their purse strings. So which are the better names to look at here?
One of the names I like is Pepsi. So it's nice that stock has already taken a hit on the potential for tariffs and how it may impact their business. In fact, that stock has actually been sliding over the past year. But we think the market's being overly pessimistic regarding the company's long-term outlook. As far as our model goes, we're only looking for slight top-line growth, only a little bit of margin rebound. So I think those are actually relatively conservative outlooks for the company. It's a 4-star rated stock at a 21% discount and one with a 4% yield. I think you can get paid on that while you wait for that stock to start rebounding and moving back upwards. And as a defensive stock, I think that will be one that will benefit from that rotation we expect in the second half of this year.
All right, you've got another brand, Constellation. It makes beer, particularly imports Corona and Modelo from Mexico. So I would imagine it would be facing some tariff headwinds here.
Exactly. Now, the thing is that both the Corona and Modelo, while they are imported from Mexico, the production of that beer does fall under the current U.S.-Mexico-Canada trade agreement. So we don't expect to see any tariffs being put on that company. I know the market is pricing in some probability of that is not our base case. Now, I will say that this is a stock we've been recommending for a while. We have been long and wrong. But when I look at the chart, I think that stock is in the process of bottoming out. And one of my favorite parts about this company that as an investor, you can support your investment here by having a couple of Coronas on the beach or by the pool this summer.
Very nice. That's something I'll be looking forward to as well. And we've been in conversation with Dave Sekera. He's the Chief Market Strategist for Morningstar Research Services. Dave, always a pleasure chatting with you. Thanks for your time today.
All right. Thank you, Ryan. Have a great rest of your day.
All right. You too. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.